I want to talk first and foremost about the numbers, about in particular the expenses rising. Was this something that you didn't signal enough to the market? Did it take you as the quarter rolled on that you were going to have charges set aside for $1 billion for customer remediation and more than $700 million for the restructuring charges?
Yeah, those two items in particular were higher than most people would have estimated. The restructuring charges will come when they come. They're a little bit harder to forecast, but they generally exist because you're taking expenses down on the other side. I think, as we said on our call earlier today, given what we know today, there's an expectation that on the customer remediation front that we're through it, and that shouldn't be part of the expense story going forward. But there's a big commitment at Wells Fargo to bring structural expenses down over the course of the next couple of years through business simplification and product simplification and a range of other things. We should be able to run this company on a somewhat lower expense base.
And getting down to that expense base, of course, I mean, this is at a time where there are still a lot of concerns here about the economy and about how healthy that economy is going to be, particularly for consumer banks. I'm curious, as you were sort of mapping things out here, heading into this earnings season here, do you get any sense here that the economic environment is going to be supportive of the current plan that Wells Fargo has in place?
Yeah, well, what we're seeing right now is a real improvement in a lot of areas over Q2 of this year, as we don't know what the path of COVID is going to be and whether the economy is going to be more open or more closed over the course of the next couple of quarters. But we're seeing consumer spending picking up. We see it through debit card. We see it through credit card. Lots more payments coming through. We see the mortgage market being wide open. People are refinancing into lower coupons. A lot of home purchase activity is happening as people are, in some cases, moving from cities to suburbs, in part because of what's happened with the virus. Autos, a lot of activity in autos has been going on through this period in time. So things are better. Credit, as a result, looks better today than we thought it would a quarter ago. I think you mentioned that provisions have been down below analyst expectations up and down the street. Our charge-offs were 29 basis points in the quarter, which mirrors the best of times. And so while we're not out of the woods because there's still uncertainty in terms of the path of where things could go, it does feel a lot better than it did a quarter ago.
Feeling better, meaning the worst is behind us in terms of delinquencies on loans, delinquencies on mortgages, even without a stimulus bill?
Well, it's tough. There are, as you know, both in the CARES Act and then offered by banks, these deferral programs that allow people to take a 90 or 180-day pass on their mortgage payment, their auto payment, or their credit card payment. We've seen the utilization of those deferrals come way down. We're probably down to about 5% of our consumer loans outstanding, and the people who have come out of deferral, by and large, have been remaining current, well above 90%. But if there is no more stimulus, when that runs its course, when these deferral programs are over, then we'll begin to see who actually rolls into delinquency. And so there'll be some ambiguity until that happens. And the worst of it in terms of charge-offs probably happens at some point in the second or third quarter of next year for both consumers and for businesses.
John, since 2018, since the Federal Reserve's consent order, you, of course, have been limited to a certain extent in terms of your balance sheet growth. Are you worried that you can't extend the sort of lending you'd like to at the moment, particularly to the consumer, particularly to small businesses that's so needed at this moment? Is there a limitation to what you can do, and will there be some sort of credit crunch in those areas?
Yeah, I don't think so on the loan side. The constraint that we have is total balance sheet size, which actually these days is more of a constraint on the deposit side, because so much liquidity has flooded into the banking system that the growth in deposits, and for certain types of deposits, we've worked with customers to find other places for that money to go. On the loan side, actually, the reverse is true. We could use more loan demand than we're seeing. Consumer loan demand actually is pretty good. I mentioned mortgages because the housing market is on fire. Autos are very busy, and people are buying cars. People have been a little bit slower to spend on their credit cards because I think they've been appropriately conservative as unemployment has peaked and then has backed off a little bit, but is still at higher levels, and there's more uncertainty in the employment environment. But consumer loans, whether it's mortgages, autos, credit cards, et cetera, there's plenty of capacity for that and enthusiasm in making those loans. On the business side, we've seen a reduction in demand for a couple reasons. One, the capital markets are wide open, and lots of larger businesses are getting their funding from the capital markets rather than their banks at the margin, which they're still big borrowers, but they're using the bond market more. And middle market customers, we've seen use their revolving lines probably 8 points lower in percentage terms than they normally would. Usually they'd be in the 40 or 45% range, and they're in the low 30s instead. And some of that is just them selling out of inventory that hasn't been replaced, and we finance the inventory for those borrowers. So we could use more loan demand there as well, where that's not a constraint.
And so, okay,
there's a lot of cash.
Yeah, a good point there. So, John, when we talk about sort of, I guess, the new type of consumer or the shift that other banks are making to grab new types of consumers, I'm wondering if Wells is comfortable, I guess, in the space that it currently operates right now, obviously given some of the regulatory constraints, but that you're comfortable in that space right now, and are there any plans at all to move, I guess, beyond that?
Yeah, so we're on the consumer side. We are a U.S. bank, and we're both a mass market bank and then an upmarket or wealth management style bank. We've got a full set of capability. In the last quarter, we introduced a new banking product that was designed really to get at people at the more of the entry level of the banking system, easier to understand, lower fees, inability to overdraft. And at the higher end of the market, we've got new leadership in our wealth management team to really try and do more and more with the people who are already our customers through our retail branch network. So there's really nothing that's holding us back from doing all that we need to court and to do business with the full spectrum of consumers, retail in the U.S.